Welcome back for another video. Be sure to like and subscribe, and let's jump right into it. In today's video, we're going to talk a little bit about risk management and just some general concepts that help you guys out when trading CFDs or indices or forex markets. So we're just going to look at some concepts there, and this is just stuff that I teach every single day in the Market Mentors Discord community, where I teach various trading concepts. I show my trading analysis, my new positions as I'm taking them, my winning trades, and just interacting with students, doing some one-on-ones, and just answering them questions for them. So check out the link in the description and join the Market Mentors Discord community so we can help you get profitable. And just getting back into it, so we're just going to talk about 10 tips that will help you be profitable whenever you're trading. So I'll type them out here. And the first one, of course, we're going to start out with is only risk what you can lose to afford. It's important that whenever you're, especially when you're starting out trading and you're really not profitable, it's important to only risk a small amount of money that you just don't care if you lose it all, basically. Because if you start doing money like your rent money, your bills money, you start to become really emotional with it, and it gets into the territory of actually starting to be gambling instead of actually smart investing. So only risk what you can afford to lose. This helps you control your emotions and helps you understand what trading is really about, just trying to build your system and follow your rules. And it helps you properly manage your trades and properly manage your risk. So only risk what you can afford to lose. Another general concept for you is use a fixed percent of your capital per trade. Percent risk per trade. And this is because it helps you really maintain and scale your account long term, because when you first start getting on trading, you might just start to try risking like a dollar amount, or you might just say, okay, I'm going to pop the same lot size or margin size every single time. And that's not really the best way to do it, because every trade or every asset is not worth the same. Like when I started out trading, I might say, okay, I'm going to pop a 0.01 or a 0.1 on every single trade I do. That doesn't really make any sense, because a lot of different factors. You have things like different markets and assets that they are not worth the same amount. So 0.1 on like something like Euro USD is more than a pair like GBP NZD. Or you might have something like gold, where it's a lot more volatile. You have a way larger stop loss than something like Euro USD or AUD USD. And of course that transitions to the index market as well. When you're trading NASDAQ, it's worth more than the S&P. So not really understanding, you need to pop a certain lot size compared to actually risking a percent of your amount of your account, whatever you can actually afford to trade. Doing it in percentage is a lot better to scale it, and helps you manage your trades and your emotions long term. So use a fixed percent. It's a good rule to start if you're new. Risk 1% of your capital. So it's going to take you a while to at least blow your account if you start going on a bad losing streak, but it's only 1% of your capital. So if you lose 100 trades straight, that's when you would blow your capital, as opposed to if you risk like 5%, 10% per trade, and you can lose 3-4 trades in a row, then you'll have a really bad drawdown on your account. So just risk 1% starting out, and you can start to increase your risk as you get better, and your actual win percentage gets better. And I'll teach you guys that in the Market Mentors Discord community. There's actual math behind when and why you should increase your risk per trade. But just starting out, risk 1% per trade. The next rule or concept we'll say is know your stop loss before you enter your trade. And this is really a key. I know a lot of beginners that do this, and of course I've talked to some traders, and it's just when they're starting out, they just think that they can kind of just enter the trade and kind of just manage it with their eyes. You really need to set a stop loss before you enter. You need to have a defined stop loss that is set already for you, that parameter set. And it should be based on something that's according to your system or your rules. It should be based on some type of price action, some type of reasoning behind it. Not just your emotions, or whenever you see price looks like it's going to go reverse to the downside or upside or against your trade, that's when you feel like you're closing out. It needs to be based on some type of reasoning that you can repeat in and out through every trade. You don't want to just say, okay, I'm going to widen this stop loss, just give it some more room or something like that. You just want to go set it and leave it there and have a reasoning behind it, and don't touch it or try to adjust it throughout the trades. Just set your stop loss and just accept what it is. This will help you avoid those really drastic losses, especially if there's something like news or something happens, there's a very volatile wick against you, and you ended up taking an extra large loss than you should have taken. So just setting your stop loss will help you limit your losses and cut them short, basically. The next one will be focus on risk to reward ratio, and that is be contingent on a lot of things like your win percentage as well and how much you're risking. So this is contingent a little bit, but it's always in general the higher the better. Basically, you want to aim for, let's say 2 or 1 or better. You can go for like 1 to 1.5 if you have a really high win percentage, and I can teach you those equations and that math behind that in Market Mentors. But in theory, if you go for 2 or 1, it's better. So let's say if you lose 1 trade, okay, that's 1% of your account. But if you win 1 trade, that'll be 2% of your account. So if you, let's say you've won 50% of your trades, you still be profitable because you win 2 times as much in a winning trade than you do in a loss. So if you were able to go for like 5R, 5 risk to reward, or 1 to 5 risk to reward, you could be very, very profitable because you're winning. The amount you win is 5 times than the amount that you lose when you have a losing trade. So always try to go for, or at least try to figure out how to get a good risk to reward whenever you're actually trading. It shouldn't just be random numbers. It should be a pretty consistent average or average range of your risk to reward, why you're doing it, and making it make sense for you. The next one, our next concept will be avoid over leveraging. So there is going to be a set margin for your account based on your account equity and the amount of trade you're taking. So CFDs can offer pretty high leverage, but that's really going to be a double-edged sword for you, because whenever you're using those you can use lower position size to kind of lower the risk in the margin. But once you start to really take a lot of trades back to back, or you start over leveraging, using too much risk for your account, your broker will start to take note of that, and they'll start closing out trades for you, especially when you're down. So if you get a lot of drawdown in the trade and you're over leveraging, using too much % risk for your account, they'll just close it out for you and you'll have a loss even if it hasn't hit your stop loss yet. So just avoid over leveraging. Use that smart amount of risk, like a fixed risk. You try to use a lower risk, like 1%, 2%, 3%, just kind of based on where you're at in your trading journey. But don't try to over leverage. Don't take too many trades. Don't use too big of a position size. The next concept will be use a trading journal to track your risk mistakes. And this also helps with just understanding your general averages and concepts. So this is going to go back to